Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Pavitra Parekh and Sonia Shenoy. For the markets, we're absolutely flat on the benchmark index right now at 11 o'clock, but there has been a recovery from the day's low. The Nifty day's low today was 17,780. So from that level, there has been an up move of close to about 80 odd points, but that up move happened somewhere between 9:30 and 10 a.m. Since then, things have been on the flatter side. We've been flatlining, though in the last 10 minutes given up a bit of ground. The mid-caps are also pretty flat, but we are now approaching important resistance levels. So the 20-day moving average and the 100-day moving average are roughly around these levels. So the 20-day moving average is 17,872. So we are about 10 points away from that level, and the Nifty 100-day moving average is about 50 points away, 17,939. So we are approaching a bit of a resistance level. Keep your eye on new age tech companies. That's where all the action is in the broader market. So Paytm, the intraday will show you it's another up day for it. In fact, in the last 4 trading sessions, Paytm has gained close to about 30%. Zomato in the last 3 trading sessions has also added a significant bit. Today, it's up close to about 3.5%, but in the last 3 days, you have seen buying to the tune of close to about 15 to 20 odd percent. So that's where the action is. And of course, the Adani episode continues to roil the stocks over there.
And I think everyone is really looking forward to what Zomato delivers, right? They're coming out with numbers today. It's still expected to be an EBITDA loss for Zomato this time around. So Mangalam was telling us that there's a loss of almost 400 crores that Zomato will post on the EBITDA front. But I think after Dipinder Goyal's tweet that he put out, where he was, talking about the path to profitability, all eyes will definitely be on Zomato. But it's all about numbers today, right? So you have Cummins that's at a fresh 52-week high because of its numbers. You have Gujarat Pipavav that's up almost about 7 odd percent. The EBITDA there went up 65%. And NCC, a couple of others, Godrej Agrovet, Oberoi Realty, etc., reacting to numbers. So while the headline index is not doing too much of a jig, it's individual stocks where all the action is.
Oh, absolutely. Also, some of these stocks which, earlier through the year did see sharp cuts, like the Bajaj twins, the life insurance players after the budget. Remember, they saw sharp cuts. Now, for this week, if you take a look at it, for example, for HDFC Life, you have a gain of almost 5.5%. SBI is up 3%. The Bajaj twins, like I was mentioning, those also, saw pretty steep cuts coming through earlier this year. But this week has been good. Bajaj Finance is up 7.3%. FinSub is up almost 4%. So, you are seeing action like Sonia pointed out in a lot of these individual names. But like we were pointing out, the key story today as well is the Adani Group stocks. And in fact, we have a lot of stocks that we are highlighting. So we have Vivek Vahishta as well as Ekta joining us to bring us up to speed with all of the details. And I'll go to Vivek first because the Adani Group of stocks are still in focus. This is after the notification by the MSCI, and the deal also with Total Energy is being put on hold. So Vivek is here to fill us in with the latest. Vivek?
Well, that's right. So on January 28th, post the publication of the report as well as the volatility that was seen as far as the Adani Group stocks was concerned, MSCI actually invited feedback from the members as to how exactly they were going to deal with all of the Adani Group stocks that were part of the MSCI Global Standard Index. Now, tomorrow or later today, actually, as USA Times, you're actually expecting the MSCI to come out with a Feb index review as far as the list of additions and deletions are concerned. So today, MSCI came out with a notification where they have actually gone ahead and assessed the feedback that they've got from all of the investor community as well as the members of the MSCI. And what they are saying is that, they are going to review the weightage as well as, how exactly they are going to treat all of the Adani Group stocks that are present in the MSCI Global Standard Index. So why is this important? Remember, all of the Adani Group stocks, barring Adani Wilmar, which is a recent listing, and NDTV, are actually part of the MSCI Global Standard Index. And in fact, when you're talking about 3 key stocks, Adani Enterprises, Adani Total Gas, and Adani Transmission, all 3 of these stocks hold significant weightage. So you could see some selling pressure emerge there if MSCI decides to remove them or reduce the weightage. Analysts indicate that in this particular February review, there's expected to be a weightage reduction as far as the Adani Group stocks are concerned. Now, coming to Total Energy statement, yesterday they declared their results, and in the post-results conference call, what they indicated was that they've put the $4 billion green hydrogen commitment that they had given to Adani New Industries Limited. This particular commitment was made in June 2022. They've said that at this point of time, they've put it on hold, awaiting feedback, awaiting the outcome of the audit, and post which they will evaluate how exactly to proceed with that particular investment.
Okay, well, thanks a lot for that. Piramal Pharma is the other one. It's under massive pressure after the company reported a weak set of third quarter numbers. Ekta, tell us what went wrong this time.
Absolutely. It is a disappointing set of numbers, and management had indicated that generally second half is when they would probably see better numbers, better recovery. That hasn't come through. The piece of news additionally, besides the numbers, is that they've approved a rights issue of around 1,050 odd crores. Now, coming to the numbers, revenue is up 11.5%. The key disappointment unequivocally is definitely the margins this time. They've come in at 5.1% versus 14.7%. The loss has widened to 90 crores versus around 37 crores on a Q-on-Q basis, but versus a profit of over 160 odd crores same time last year. Q-on-Q as well, margins at 5.1% versus 10%. Now, 9 months as well, as a whole, the margins have come in at 6% versus 12%, and the loss is at over 230 odd crores. Now, in terms of the revenue, it's really not a revenue problem. The street would have forgiven the company if it was a revenue issue. CDMO Q3 revenue is up around 14% year-on-year. Complex hospital generics, which is basically anesthesia, drugs, etc., is up 6% year-on-year. India consumer health, which is basically a whole host of brands which they sell, many of them over the counter, is up around 37% year-on-year, so that's done very well. They also have a strong track record when it comes to the US FDA, 12 years, no OAIs or official action indicated status, but the street doesn't really want to look at that at this point in time. Stock is down over 50% from the listing price of around 201 rupees. And remember, until now, post the listing, there have been a couple of brokerages which have been quite positive on it. For example, Axis Cap initiated a coverage with a buy at a target price of 160, and Jefferies initiated with a buy and a target price of 150. Stock is way below those target prices. Call at 5 p.m. today. So the street will watch out for what the management has to say.
Okay, Ekta, thank you very much for that. By the way, the string of negative earnings from pharma continues, right? Particularly on the margin miss. So Piramal Pharma she spoke about, but you remember Divi's Laboratory, 40% plus margins. They came down to 23, 24%. Even Laurus Labs margins were at the lowest level that we've seen in the last 4 quarters. So this pricing pressure is hitting many of the pharmaceutical companies this quarter, and margins particularly have been weak for Laurus Labs, Divi's Laboratory, and now even Piramal Pharma. So that's a bit of a worry, right?
And it is showing up in the stock prices as well, right? But on the flip side, Cummins, there's a lot of opportunity in the railway sector. As we know, the government is also going in, all guns blazing in the sector. So Cummins is one of the beneficiaries of it, perhaps. It delivered a strong performance in this quarter, and there was a conference call as well. Vahishta is here to give us the latest over there. Vahishta, over to you.
Hi, Sonia. Thanks for that. Well, Cummins, as you said, has delivered excellent set of numbers in Q3 of FY23. In fact, the company reported a record quarterly performance which was driven by a strong domestic as well as the export revenues. The revenues came in at 2,100 crores, which is 12% above the estimates and 330 basis points above the estimates as well. The export revenues have jumped 23%, while the domestic sales were higher by 27% on a year-on-year basis. Like you mentioned, the con call was just a few minutes back, wherein the company has said that they are optimistic to meet the revenue growth guidance, which is 2 times the GDP growth of FY23. However, the company is cautiously optimistic and is watchful for the softening of the capex cycle. The company has said that the margins in Q3 were better off due to better execution and supply chain challenges, which have eased off in this quarter. But the rise of copper, aluminium and steel prices is some kind of worrying situation for the sustainability of the margins going forward. Also, as India moves towards 5G and consumes more data, the need for data centers is expected to be robust in the next 4 to 5 years, and Cummins is one of the leaders in the data center space. Also, the company has said they are witnessing growth across the board due to a strong demand. The growth in high horsepower has come in due to a high demand from infra, from realty, from data centers, while the power generation segment growth was led by infra, hospitality and the manufacturing space. Alongside, there were commentaries on the tighter emission norms in the ongoing decade with CP/CB4 implementation, wherein the cost increase could be as much as 50%, while the company expects to take price hikes in the range of 30 to 50%. Also, export potential for the industrial segment is strong, especially in the marine and the construction segments. The North American and the European markets are also continuing to doing very well. So the exports are also strong. Company has not witnessed any market share gains though recently, and this is due to the insufficient capacity to meet its existing high demand. And with ongoing supply chain challenges that they are facing, the company has said they are still cautiously optimistic on the short to medium-term demand. So, of course, the stock is flying up in trade. Let's see how it pans out in the latter part of the day. Back to you.
You remember historically Cummins used to give us a guidance, but for the last couple of quarters they've stopped giving a guidance, citing uncertainty, and this time as well cautiously optimistic, but they are confident that they will grow faster than India's GDP, 2x of India's GDP growth. Get into a break, but as we do that, let's listen in to some important voices coming in from the IBLA jury, Sanjeev Mehta of HUL, Anisha of M&M and Prabha Narasimhan of Colgate.
The rate of inflation will go down. But if we really have to give a fillip to consumption as in volume growth, then we have to see commodity prices go down substantially, which would then result in corporations like ours passing the benefit to the consumers. Then the consumption would come back.
And you're not at that point?
We aren't at that stage. Rate of price hike would be substantially lower. But what you would see in the price growth would first be coming in from the price increases that were taken in the second half of the last year.
We are seeing very strong consumption across all our sectors. In auto, it's driven by products that we have. Surprisingly, the farm sector has held up very well. And the growth in farm equipment, in tractors in particular, has been far higher than what we've expected this year.
There is a fundamental difference. Tractors are not owned by farm hands. Farm hands consumption is driven by wages. Yeah, and it is not that the growth is not there. If you look at the full year 22, we are still talking about the top line or the headline growth still being positive even in rural India. But for the kind of price increase we have seen, which has been unprecedented, it's also not surprising that the consumers have titrated the volume.
What we're seeing actually is very similar to what Mr. Mehta said in terms of the rural consumption not coming back as fast, and certainly amongst the rural poor, we are seeing consumption being under serious pressure, particularly in categories that are not seen as fully essential, and a choice can be made. What we are seeing at the other end of the spectrum is premium urban consumers are actually driving market demand, and premiumization continues to grow apace. So it's kind of like a two-phased market. And in terms of pack sizes and down trading, we're not seeing any significant shift as yet, more just a curtailment of consumption where money is tight and wages are not coming back to meet the inflation that's happening in their baskets. But it will come, and we are seeing a little bit of green shoots, so hopefully it will come as we go on. And obviously there is always more opportunity at the premiumization end of the spectrum as far as India is concerned.
Welcome back to Trading Hour on CNBC-TV18. Well, one of the stocks which is really surging now is Uno Minda. So just pick up that stock for you on the charts. It's at 526, so that's a 4% gain today. We had the management just a while back and they told us about how bullish they are on two segments. Airbags, because most cars will now need more airbags as we move into the new year, as well as the four-wheeler lighting business. So their expectation is that from a quarterly run rate of 650 crores per quarter, they're expecting to go to 900 to 1,000 crores per quarter in the four-wheeler lighting business, in the lighting business overall, and that has taken the stock up and about. But let's also get going on what's happening in the world of commodities, because crude has been surging quite a bit, above $85 a barrel now. Manisha Gupta is here with more on that. Manisha, over to you.
Thank you for that, Sonia. Well, yes, we have seen strength continue for the crude oil prices for a third straight day today. And this is even as the U.S. Inventories for crude have risen for a seventh straight week. And the U.S. inventories are now the highest since April 2020. The support from crude comes in from the fact that there are some supply disruptions right now. Saudi Arabia, for one, has hiked the Asian official prices for the first time in 6 months. All these 6 months, they were giving a discount. But this is the time when they feel that the demand is coming back and the consumers are willing to pay higher prices for crude. The higher demand estimates from China is another reason that you have seen support come in for various asset classes, including commodities and crude as well. And then now there have been suspended operations at Ceyhan port in Turkey after the earthquake. That hasn't resumed yet. And to add to that, BP also has shut one of its Azerbaijan ports there because of the similar concerns. There also are reports of shutdown on oil fields in Norway. So various geographies are reporting lower oil production, and inventories could be impacted. Because of that is the reason you are looking at some support out in case of crude oil prices. But here's a view also from Vandana Hari of Vanda Insights on what her sense is on where the crude prices could be headed in days to come.
I'm not in that camp of Uber bulls calling for $100 a barrel, and the reason for that is that I do not expect Chinese demand to come back, bouncing back so fast that it takes everybody by surprise, especially OPEC plus. Indian oil demand, first of all, Indian energy demand absolutely will continue to rise. Also, it's pure demographics, right? It's a country with a growing population, soon to be, unless it's already the largest population in the world. And also more urbanization, better standards of living, better expectations from people with regard to their lifestyle. So absolutely rising demand.
All right, that is an important word coming in on the outlook on crude oil prices, currently around $85 a barrel. But with that, we are going to get into a short break now. When we come back, we'll talk about the earnings of Syrma SGS Technologies. The management will join us on the other side. Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and let's now get you a corporate conversation. Syrma SGS Tech is on our radar on the back of its third quarter earnings. The revenue and profits saw steady growth this time around. However, the margins is where we have seen some pressure. So to discuss the quarter gone by as well as the outlook going forward, we're joined by Sandeep Tandon, who's chairman of the company right now. Sandeep, good morning. Thank you very much for joining us. I'll get to the margins in a bit, but on the growth front, I remember you said that you are likely to grow in line with the industry. You're obviously growing well above that. I know your guidance for FY23 was 1,700, and I think you've already done around 1,400, right? So I'm sure you want to revise that guidance upwards.
No, yeah, the growth has been very strong, and like I told you, we're well ahead of the industry growth also. We are seeing very strong interest from customers, but of course, life is not so easy when you're growing, right? So that the downside of that is, margin pressure in the sense of, getting the plants optimally utilized, productivity and supply chains when you're managing. Those are tougher when you're growing at that scale. But definitely, yeah, I would revise it, but I'll stick to what I said earlier. So give the team a little breathing room.
FY25, you had a target of around 3,500 crores of revenues. You stick to that target?
Yes, we do.
Okay, and what do you think would lead to that? I mean, what is the kind of growth that you're looking at across segments? Of course, in your auto segment, you've done very well. It's a 70% growth this time. But auto, consumer, healthcare, where do you see the big triggers coming from in the quarters to come?
So the beauty is we are spread across many verticals. So we're, not dependent. But industrial, we are seeing strong qualifications from customers. So last quarter was a lot of qualifications of customers who approved our plants for production. So we should be playing catch up on the industrials. And healthcare, we should see also revival in the numbers that you should see that, that were not as great last quarter because of general slowdown in Europe. But that we believe should start picking up from Q1 next year. Those are the main that I'm seeing a lot of growth. Of course, consumer continues to be strong. What we classify as consumer, we have telecom equipment also in that category of consumer, where it's customer premise equipment that we're manufacturing.
Sandeep, you did say at the beginning that this growth seems to have come at the expense of margins. You had an aspiration to hit double-digit growth, right? Double-digit margins.
So we are sticking to double-digit margin. If I told you, always said, whenever somebody else's margin is my opportunity. So we have to win customers, right? Win customers and at the same time scale customers. So when you're scaling, you can't get the same kind of margin that you're expecting. But I've always said we will be double-digit EBITDA margins, which we continue to plow through. But of course, when you're growing, you have to productivity, scrap, yield, those things are created when you're growing that fast. But we will continue to, hit our numbers.
So FY24, we could see double-digit margins?
Yeah. We will endeavor to double-digit all the time.
Endeavor. And what about your order book? In Q2 or September end, it was 17,000 crore plus. What would the comparable number stand at?
So right now, our 12-month forward is confirmed order book is 2,100 plus.
Got
Okay, Sandeep, in your press release, I think you mentioned that some near-term challenges still remain. So do you want to detail those out for us? I mean, from what you're saying, it sounds like demand is clearly not the problem. So where is that pressure really coming from?
So it's different verticals that are, the challenges where something goes down, something comes up. So that doesn't create the optimal. Like ideally, I would love everything to go up. So that's not the case right now. But because I mean, you've seen what the challenges in Europe has been right this quarter. So what happened in the order book got little. Q3 for Europe, financial Q3 for Europe has been tough because of their energy situation. A lot of customers didn't want backlog in their factories. So we were not allowed to ship a lot also last quarter.
How much is Europe for you, Sandeep?
I didn't catch the question. I lost you.
How much is Europe? How much does it contribute to your revenues?
So as a contribution of Europe would be about 8 to 10% for Europe, but that hit was a little harder on our numbers.
Okay, so 8 to 10% comes from Europe, and overall, I think 26% comes from the export market, right?
Yeah, so typically, which was we were at 36% last year, is down to 26 this last quarter, which we are going to see recovery very quickly.
So apart from Europe, any other export markets where you're seeing challenges?
No, I actually, US is quite robust. The market continues to be robust. We're not seeing the challenges. Of course, there's caution in Europe. I mean, US. Europe, we are seeing a lot of challenges.
Any new customers that you've added, apart from these challenging markets that you spoke about, in the markets that are doing well, any new customers?
Yeah, so we've added 3 new customers. I can't disclose the name, but in the industrial segment, we've added new customers in the last 3 months. So that what in our case, customer added means revenue audited, and then revenues only start 8 to 9 months later. So that's the challenge that you face, and it's like approval of the plant, approval of the NPI of the new product, and then start shipments.
So these 3 new customers that you've added, you're saying that the revenues will flow through about 8-9 months later. So are you looking at it in FY24 itself?
Yeah, towards the end of FY24.
And can you share what the approximate order quantum would be?
No, I've given you full overall guidance of the numbers that we have on our order book, which will be within that, and hopefully we'll beat that number.
Sandeep, we'll leave it at that. Thank you very much for joining in. That's Syrma SGS maintaining their FY23 guidance, 1,700 crore plus on the top line. Their endeavor is to hit double-digit margins. Exports are a bit subdued. Export contribution has come down drastically from 36% now down to 26%. But the order pipeline is very strong. The confirmed order book has gone up by 400 crores on a quarter-on-quarter basis. 2,100 versus 1,700 on a quarter-on-quarter basis. The stock is up 1.5%. Get into a break. We'll come back, discuss market technicals with Rahul Mohinder. Stay tuned. Welcome back. Here is our proud moment from everyone here at CNBC-TV18. Once again, we have beaten all competition on Budget Day with a whopping 88.2% viewership during the Finance Minister's speech and 82.2% viewership throughout the day on the 1st of February, the big Budget Day. So here is a big thank you to all our viewers for your continuous trust and patronage and for keeping it with CNBC-TV18 through the day. And this is such a big day for us, right? So it's, we're so proud that, all our viewers are watching us. And it's a big thank you, not just from us, but there's so many people behind the screens who contribute to putting up the show that everyone's watching.
Absolutely. And it is only our viewers that we have to thank for this, right? We're nowhere without them. So thank you once again to all our viewers for following us on various platforms, not just on television, of course, on Twitter as well, on other platforms too. Thank you for the patronage. And, as Rima was saying, I mean, anchors are just a very small portion of what you see on TV. The rest of the whole family, right? Whether it's editors, producers, the desk, the guests, the guests as well. We have to thank all our guests for giving us that big picture, analyzing threadbare the budget for us and making our budget such a big successful event year after year. So, I mean, it's a team effort, and I'm so glad that we could sort of pull it through this time around as well. So, congratulations to our viewers and the entire CNBC-TV18 family.
Oh, absolutely. Like you guys were pointing out, it's really when you see the entire unit just come together and, deliver. So, it's great to be a part of the team, of course, on a day like this. And it's good that it translates on screen as well. And, I guess like Rima and Sonia mentioned, it's so nice to know that there are so many people working behind the scenes to really get us all of this, and that it's translating. So
and I think the budget consumption has changed so much over the last many years.
Yeah.
I mean, of course, maybe 10 years ago, you only consumed the budget on TV.
Yeah.
Now you consume the budget minute by minute on various social media platforms, on Twitter. So it makes the job even tougher, right, for media channels like ours. So, I mean, we're grateful, of course, that we could roll it out in such a great fashion across multimedia platforms. And thank you once again to all our viewers, 88.2% viewership. So 2 thumbs up to CNBC TV18.
Absolutely. And we've got some numbers that we will be watching very closely. The January monthly data, how is it looking?
All right, so there definitely is quite a pickup. It's coming at over 12,400 crores. This is the overall inflows into equity schemes. This is versus around 7,000 crores that we saw last time. So that is looking very strong. But we will get some more details on that as well in just a bit.
Okay, in the meanwhile, we'll get chatting with Rahul Mohinder of VeraTechIndia.com to talk about the market technicals. Rahul, very flat, right? Is there a trade on the Nifty or in individual stocks that you'd like to advise our viewers?
Morning. I think, yes, whilst the market is flat intraday, it's been swinging. Let's not forget we were at 17,400 just a couple of days ago. So we've had a bit of a good run up. And I think when I look at some of the index heavyweights, and this is where my conviction comes from, that the market is probably attempting another up move. And what traders are probably waiting for is to see that we kind of stick above 17,900. We're toying with that level for the last day or two. We've not yet crossed it convincingly, but I think that's the final sense of confidence which a lot of retail traders will kind of seek confirmation from. So my sense is we are moving up. We're probably moving up to 18,050 to 18,100, somewhere in that orbit. If I'm a short-term trader, I need to be buying. And even if I'm someone trying to take a bit of a position for the medium haul, my sense is 17,750. This is probably going to be a great base to keep in mind, a good level to keep in mind. If we don't close below 17,750, I think we could have a decent trot that builds up from here. It's early days for me to say, but again, I see those initial signs, which gives me the courage. And when I look at the index heavyweights, that's where the confidence comes from. So coming to 2 or 3 stock calls, going with my theme, 3 of the top 10 index heavyweights, which I'm going to be talking about. One is Reliance, of course. We've seen the last week or two between that range of 2,300 to 2,370. I think we are attempting a breakout here, just looking at the whole volume setup. The fact that we've marked a lot of time in this range also means there's a lot of money that's kind of moved in at these levels. So there's a lot of accumulation, in my opinion, that's happening here. Again, the breakout hasn't occurred. I'm kind of, putting my neck forward on this. But if you could go ahead and buy the stock at current levels, even as a short-term trader, 2390 would be my initial target. If I could hold on for a couple of days, 2450 is probably on the cards. I would attempt this by keeping a clear stop loss at 2330 levels. The second one is TCS. The stock has continuously outperformed. It's one of those strong ones within this sideways market, but I think it continues its trajectory towards 3610. So that would be my target on TCS, and I'd keep a stop loss at 3490 if going long at the current levels. And finally, ICICI Bank, which is still, again, marking time, but it's got those little patterns which I'd look for, which could help it bubble out into a good up move. So, if I look at buying at the current levels, 840 is a good stop loss. I'd at least expect it to move to its previous intermediate top, which it made in January at about 882. So for an 882 target, 840 stop loss, I'd buy ICICI Bank.
Okay, by the way, I just want to mention that CNBC-TV18 has achieved dominance through the budget week, not just on the budget day. So once again, thank you to all our viewers. And Rahul, you've been a part of this journey for very long as well. So it's as much your, prize to win as much as it is ours. So thank you so much for being a part of the CNBC-TV18 family. And once again, to all our viewers, thanks a lot for tuning in, for joining in, and for consuming our budget day coverage. As always, India watched Budget 2023 and Budget through the course of the years on CNBC TV18. So thank you for that. Let's take a quick break on that note. On the other side, we'll discuss market fundamentals. Varun Goel of Nippon India AIF will be with us. Welcome back to Trading Hour on CNBC TV18. Well, for now, the market is very, very quiet, but there's some amount of pressure that we're seeing on the banking space. The Bank Nifty is now down over 200 odd points, but we are here at CNBC TV18 celebrating the budget day ratings. So as always, CNBC TV18 is the #1 platform for all kind of budget consumption on budget day and through the course of the week as well. So once again, here's a big thank you to all our viewers. Varun Goel, the head equity at Nippon India AIF, joins us on the show to talk more about what to expect in the days and weeks to come. Varun, hi, good morning, and thanks for being with us. There's a big debate on what's going to happen with these new age tech companies. Yes, the stock prices have recovered, but to be fair, it's only Paytm that has showcased some profitability. The rest are yet to do that, whether it's PB Fintech or even Zomato. At this point, do you think the risk reward is favorable for long-term investors to buy into any of these names?
Good morning, Sonia. Thanks for having me on the show, and congratulations to you and the CNBC team for the great budget day achievement of 88% viewership. It's a great achievement for all of you. Thanks. As far as the tech companies are concerned, I think we have consistently stayed away from them. I think some of these new age tech names need to demonstrate profitable business models before they become long-term investable stories. I think at this point of time, there is still a lot of hope built in terms of when EBITDA break-evens and PAT break-evens will happen. We will wait for more clarity. I think some of them are seeing evolving business models. So we'll wait till we have clear signs that the business models have settled down, and then we'll take a fresh call on them.
Varun, morning. Can you talk about the call that you have on healthcare, the overweight call on healthcare? Because a lot of the pharma companies, the traditional pharma companies like Divi's Laboratory, Loris Laboratory, and now even Piramal Pharma have reported very weak margins. There is pricing pressure. Can you talk about why you're overweight on healthcare and which segment you like in that?
Good morning, Rima. Thanks for having us. So I think broadly, as far as the healthcare space is concerned, instead of the conventional times when we had just the pharmaceutical business as an investable opportunity, now we have companies in the diagnostic space, we have companies in the hospital space, and of course there is the pharmaceutical names. We remain quite constructive on the domestic healthcare stories. I think the hospital space is undergoing a very large shift. There is shift from unorganized to organized. I think what COVID has taught us that whenever there is an illness in the family, all of us prefer to go to a corporate hospital, and that's where we are seeing a lot of businesses moving. Also, the fact that insurance is playing for more and more customers nowadays is also enabling that shift. So we remain quite positive on select names in the hospital space. I think diagnostic space is undergoing some correction because of very large numbers which were seen during the COVID times. I think once we have seen valuations correct to a reasonable levels, these names will again become investable. As far as the pharmaceutical companies are concerned, we believe that US generic opportunity will continue to see pressure on margins. Healthcare in US has become a very political issue, and as such, we see pressure on pricing continue there for the next few years. We like select stories on the domestic formulation side, which is where we believe some value is there, and we should see 10-15% compounding for the next few years. But we would largely stay away from the US generic opportunity.
All right. Hi, Varun. Thanks for joining us. This is Pavitra. What do you think of the new age companies? Because a lot of them, have been in focus. We had Paytm earlier turning adjusted EBITDA positive. well before they expected. You have Zomato, and a lot of these are buzzing around as well right now. Do you think you would now venture into any of them after they have corrected so much from the top? Valuations also seem more reasonable. Do you think any of them are worth a look?
Good morning, Pavitra. I think at current point of time, we would stay with companies which have already profitable, good ROEs, good cash flows. So our preference would be to conventional IT companies. I think there was a lot of fear about US recession last year, because of which IT sector companies corrected 30, 40, 50%. I think now it's a good time to start buying into them, considering the fact that valuations have become attractive. I think most large cap IT companies should see 8 to 10% revenue growth. The mid-tier companies can see 10 to 15% revenue growth with the expansion in margins, considering the fact that the worst of employee cost pressures are now behind them. So we have turned constructive on the mid-cap IT space, and that's where we would like to do bottom-up stock pick.
Okay, pleasure speaking to you, Varun. Thanks a lot for joining in and giving us your views on the market. By the way, they've turned constructive on the IT space, but just take a look at some of these stocks. I mean, zooming away now for many of the names, where there's some follow-on buying as well that you're seeing across the board. And some of the Adani Group stocks are also coming back a tad bit, really. I mean, it's still very volatile, but something like an Adani Wilmar is up about 5%. Let's slip into a short break. We'll get you more on the markets on the other side.
देखो देखो देखो